Welcome to the latest episode of our podcast series for financial advisors. Today's episode is what it really takes to become a multi-million-dollar producer. Author and coach Dave Mullen's powerful and proven strategies. It's a conversation with the founding partner and principal of Altius Learning. I'm Mindy Diamond, and this is the Diamond Podcast for financial advisors. At Diamond Consultants, our mission is to help advisors live their best business life. We want every elite advisor to find exactly the right place for their business and their clients to thrive, whether it's at a wirehouse, a regional, boutique, or independent firm. As the industry's leading recruiters and consultants, we've transitioned more than $250 billion in assets under management in the past decade, and each year, 25% of transitioning advisors who manage $1 billion or more are our clients. If you'd like to talk, please feel free to give us a call at 908-879-1002. Are you a financial advisor who's curious about whether you're in the best place to serve clients, or if there might be a better way to optimize your business for the future? Should I Stay or Should I Go is a new book that serves as a self-guided journey, walking you through the key steps that Diamond Consultants takes with our advisor clients, whether considering change or not. Visit diamond-consultants.com/thebook to learn more. This is one of those transformative episodes that serves as a free coaching session for advisors who are striving to elevate their production levels. Whether you have your sights set on hitting $1 million in revenue or looking to double or triple your current production, my guest on this episode has tried and true best practices to get you there. That is, Dave Mullen literally wrote the book on the topic. Actually, Dave wrote 3 best-selling books based on the industry-leading methodologies he employed as a managing director at Merrill, where he hired, trained, and managed over 500 advisors during his tenure at the firm. After retiring from Merrill in 2007, Dave launched the coaching and training firm LearnTactic, now known as Altius Learning, to help advisors at all levels up their games. So if you're a fan of the $1 Million Financial Services Practice, the $1 Million Advisor, or the $1 Million Financial Advisor team, this will serve as a mini masterclass with Dave himself. He shares powerful and proven strategies from his experience at Merrill and from his current coaching practice, and answers some of the top questions advisors have asked us about growth. Dave's a treasure trove of information with a lot to discuss. So let's get to it. Dave, thank you so much for joining me today.
You're welcome. I'm looking forward to it.
Great. All right. A lot to unpack, a lot of things you've done in your career, and a lot we want to hear about. So we're going to jump right in. So you've had a long and storied career in wealth management. Can you tell us a little bit about your professional background?
Yes. Thank you for asking. I started in the business in 1980, like 44 years ago, with Merrill Lynch. Started as a financial advisor in the Atlanta market, built a successful practice with Merrill, and was offered the opportunity to go into management with Merrill Lynch, which I did in 1986, and had a 30-year career in total. Most of that in a leadership or management position. I managed a number of different markets in the Merrill system, to include the Orange County market, the Minneapolis, St. Paul market. I was a national sales manager in New York. I managed the Atlanta. I was a market executive for the Atlanta Buckhead office, and ended my career as the managing director of Colorado for Merrill Lynch. Retired in 2007 after almost 30 years with Merrill, and felt like there was a real gap in the training that was provided for financial advisors in our industry. I've always been a student of the business, learning from many of the top advisors that I worked with, and felt that it would be a great second career for me to start a training and coaching firm that I felt was needed in the industry at the time. So in 2007, I founded what's now called Altius Learning, 18 years ago. Have written 3 books since then about the industry in practice management and how to run a more effective practice and build an effective practice. We now have a number of different coaches, work with all firms to include RIAs, independents, wirehouses. We have an international presence and have a very thriving business right now. So it's been a great second career.
Yes. And I want to unpack all of that. It's being the author of those 3 books that I think will be the meat of what we talk about. But I'd love to hear about your time at Merrill for right this minute. And I know that part of what you did was train more than 500 advisors. I also know that the success rate of those training programs was always significantly higher than the industry average. So do tell, like, what was the secret sauce?
So I'll really focus on our new advisor training program, which we had a particularly high level of success with. And as I think about the components that really distinguished our training from others that were done at Merrill, was that we, number one, we hired right, which goes without saying. And if you hire the right people, then, that makes the training easier. And so we really did focus on hiring the right advisors and felt like we did a good job of that. But then once we would bring the new advisor in, we really believed that during that first 4 or 5 months, that really preparing to build a strong pipeline of prospects and manage that pipeline effectively was really important. So we would have our new advisors identify what niche markets they wanted to pursue, have them develop a detailed marketing plan on how they were going to get in front of those prospects that were in their niche markets and be successful in terms of meeting them and cultivating them into prospects and ultimately clients. We would actually have them role play in front of our management team so that we could, before they even started, really be able to give them input and feedback and really refine their scripts and make sure that they really had all that done and set by the time they went live in production. And so they were well prepared. I call it a little bit like a boot camp in advance. And then once they actually got started, we believe strongly in frequency of coaching. And so we would meet with the advisors every week to review their activities and the results and make sure that they stayed on track with their plan. And finally, there was a high level of accountability that we asked them to provide what the results and activities were so that they knew that we were watching and monitoring and making sure that they were on track with their goals. And while that doesn't sound like a very complicated formula, it led to having the number one new advisor training program or success rate in the Merrill system. In fact, Merrill actually had several of their training coordinators visit our market to see what we were doing that really distinguished ourselves from my other Merrill colleagues.
That's wonderful. And the training programs at the big firms are often head scratchers. Big firms are in and out of them altogether. They're constantly trying to rejigger them to find the secret sauce or the best practice for who the right target candidate is and how to train them. To your knowledge, what differs today in the big firm training programs than your methodology?
Well, that's a good question. I think that the training departments are definitely focused on helping the advisors achieve a certain level of success, but I think there are some gaps in terms of advisors that need training that really aren't being served, to my knowledge, very well. And that would be the emerging advisor. I think a lot of attention is spent on the new advisor, but the emerging advisor are the advisors that have successfully completed the new advisor program but really haven't established $1 million practice yet, or are on teams that haven't contributed $1 million yet. And I think there's a real gap in training those advisors on getting to that $1 million level, because I see the firms, they offer training for the new advisors, and I see that they offer training for the most successful advisors. But the emerging advisor, I really haven't seen much attention spent to. And I'm not aware of any program that any of the firms provide that really help. They've been into business maybe 3 years to 8 years, and they've got clients, but they still need to grow. And there just doesn't seem to be a lot of attention on, I think, that very important group.
So I love that. I tend to agree with that. And I think that the firms spend money on training a newbie, and there's a very high failure rate and a lot of energy into helping those that are already really successful. But you're right, there's that forgotten middle. And I think part of the philosophy is that they put those people, those emerging advisors, as you call them, on teams. And it's the expectation that the senior advisor on the team is meant to train or mentor that advisor. And that's great. But there's no real consistency then in training. Not everybody will train the same way. And you won't get the same results. So I think that's really smart. And I love that.
Could I just add a couple quick points on that?
Yeah.
One is that if you look at how senior advisors have built their business, the tactics and techniques and the prospecting methods that they use don't work anymore. And so when you're relying on the senior partners to train people, newer advisors or junior advisors are bringing on their team, they really don't know how to effectively train them on bringing in new clients and assets, given that the old prospecting methods don't work anymore. And so there's a real fallacy, I believe, in our industry of having senior team members trying to teach or mentor newer advisors on how to bring in new business because, frankly, what they did to build their business isn't effective anymore. So I think there's a real gap there.
And are those tactics that no longer work include cold calling? Is that what you're referring to? What else specifically doesn't work?
Well, what doesn't work is cold calling. What doesn't work is mailing. What doesn't work is inviting people that you don't know to seminars. Those are all the traditional ways that many of the senior advisors built their practices. And with the telemarketers and the spam calls and all the things that affluent individuals are being inundated with, they just don't answer their phones anymore. So you have to be more creative and really focus on warm marketing as opposed to the traditional cold marketing techniques that advisors in the past have used to build their practices.
Yeah. So again, as we talk more about the 3 books that you've written, we're going to get into what some of the secret sauce then is, the best practices for experienced advisors if those old tactics don't work. But let's share a little bit. Let me tell our listeners that may not be familiar with you what you've done. So there were many advisor accolades of yours, and your books hopefully or probably need no introduction. But for those unfamiliar, I know you've written 3 books that transformed the wealth management space. Book 1 was the $1 Million Financial Services Practice. Book 2 was the $1 Million Financial Advisor. And book 3 was the $1 Million Financial Advisor Team. And those books offer powerful and actionable lessons and strategies for growth and success. I want to hear certainly more about those lessons. But I want to start by asking you about those titles. I started in the business about 30 years ago. And 30 years ago, $1 million advisor was the pinnacle. We use the term like when you become $1 million advisor, you were major successful. And while $1 million advisor is still nothing to sneeze at, there are many $5 and $10 million teams and $20 million advisors, and people certainly, advisors aspiring to produce much more than that annually. So what do you think about? Are the titles outdated? Is $1 million still what we strive for? How do you think about that?
It's a great question. And it's interesting. I have never been asked that question before, but it's a good one. And so I would answer it the following way. One is that my first book, The $1 Million Financial Services Practice, was really designed for advisors that wanted to build a successful practice. So back when you started 30 years ago, if you achieved $1 million practice in 15 or 20 years, that would be great.
Yeah.
Now it's 5 to 10 years. And so it's still the first, in my view, the first big goal that every new advisor should have. And that is, how do I reach that first million in production? And then my second book was really designed on once you reach the $1 million practice, how do you take it to a multi-million dollar plus practice? And so if I had to change the title again, I would probably say the how to achieve a multi-million dollar practice or the multi-million dollar advisor.
Yeah.
I wrote the book back in 2012. And so once you have the title, you can't change it.
Yeah. Well, so is it still relevant? Are the practices and strategies that you talk about in those books, are they still relevant even though the goals might have gotten bigger?
100%. Absolutely no question about that.
So, can you share some of the most transformative strategies you observed? And I appreciate you sharing that a lot of your training experience at Merrill was focused on training the newer advisor. We talk about and agree that there's a gap in training the emerging advisor. But if we pivot now to talking about, we said goal one is to get to $1 million, to be an individual advisor producing $1 million in 5 to 10 years from beginning. If we look then on goal two, how do you take the $1 million practice to a multi-million-dollar practice? What are some of the most transformative strategies you observed?
So I want to be clear on your question. Do you want me to talk to you about the traits of highly successful advisors, or do you want me to talk about the tactics of reaching
Both.
a million
Well,
dollar?
absolutely both. That would be wonderful.
Okay. So let me, again, in interest of time, go through this quickly. Number one, in terms of traits, is the most successful advisors I have worked with, interviewed, known, coached, all have a mindset about their ability and their confidence to make a positive difference in the lives of their clients. They truly believe that if a client or a prospective client works with them, that they can have a positive difference on their lives. And that confidence comes through in a very strong way. And it's a trait that they all share. The second thing that I would say is that no matter how successful a top advisor is, they're never satisfied. And it's
Mhm.
not about the money anymore. It's just about being the best they can be. They're overachievers, they're high achievers. They keep trying to get better and they never quit. The other thing I would say is a successful trait is they have an optimistic view on life, on the industry, on their practice. They're optimists. They certainly understand setbacks and things can not always be ideal, but that never stops them from their optimistic view. The other thing I would say is that, and this actually feeds into your point about what are some of the things they do to reach the highest level, is they spend their time on the right activities. There are so many activities that are distracting in this business, and many advisors spend their time reacting as opposed to being proactive. The most productive activities are connecting with their top clients in a variety of ways and bringing in new high net worth clients. Those are the right activities, but most advisors aren't proactive in that, particularly as they have more experience in the business. They spend very little time on the acquisition side. The other thing is they're good delegators. These top advisors understand the most important things they need to do, which is contacting their top clients and bringing in new high net worth clients. They build teams so they can delegate tasks that aren't the most productive to their team members. Additionally, they have a high level of empathy. Their clients know that they care about them. It's not just that they're a client, they're a person. The advisors show that they care about them, their families, and their lives, and they go deeper than just a business relationship. Finally, I would say that they have a high level of resiliency. This business can set you back on your heels easily with market conditions that they can't control, setbacks that inevitably happen in running a business. These top advisors bounce back and have a high level of resiliency. So I know that's a lot to unpack and a lot of information, but those would be my thoughts about the characteristics of the top advisors that I've worked with and coached.
So I love that. And I work with top advisors coming from a different perspective as you. And I would agree with your observations in terms those being the traits. I want to delve deeper into this because in my experience, growth is the number one priority of most every advisor. Of course, they want to do it the right way. Of course, they want to build efficient practices. Of course, they want to be good to their team, and they have lots of different priorities. But if I had to pick the number one common ground, it's about growing the right way. So, what are some of the strategies that you've seen some of the most growth oriented top teams deploying?
It's a Very good question. And I could spend an entire podcast just delving deeply into acquisition strategies for experienced advisors. But the top line is that without a doubt, the most productive, time efficient acquisition strategy that an experienced financial advisor can engage in is client referrals. Nobody would be surprised by that observation. But what people may be surprised about is how few experienced advisors actually have a consistent, proactive referral process as part of their practice. Really has shown through their research that 80% of a highly satisfied high net worth client is willing to provide referrals to their advisor. 80%. And yet, when those clients are asked, have you had a referral conversation with your primary financial advisor? The answer is only 10% of the time. So you've got an industry where everybody knows client referrals, the easiest way to bring in new clients. And clients are willing, if they're highly satisfied, to provide referrals, but only 10% of advisors have a consistent proactive referral process. And so there's this big gap between what clients are willing to provide and what advisors are doing about it. If a financial advisor does not have a consistent, proactive referral process, that is by far the number one thing that they should be focused on for acquisition. It is by far the most productive acquisition strategy an advisor can engage in.
What do you think, Dave, stops them? So if we all know that, it sounds like what you're saying is it's low-hanging fruit and everybody knows it. So what is it that prevents 90% of advisors from going for it?
It falls into one general category, and that is that experienced advisors are uncomfortable with the referral conversation. They feel like they are pushing themselves on the client. They feel like they are selling the client. It's about the client always, not about them. When they ask for a referral, they're asking for themselves, not to the benefit of the client. It all falls in that general category of advisors not feeling comfortable with how to position a referral in a professional way that doesn't come across as being needy, pushy, or salesy. If we can help advisors with that mental shift, that a referral conversation isn't about the advisor, it's about helping the client with people they know and care about, because the advisor is capable of helping their friends, family, and colleagues in the same way that they've helped them. If you can get the advisor to think about it as an offer to help clients with people they care about, as opposed to it being based on them, then that's transformational in terms of their thinking.
And I know what I've learned, that in every bit of communication, content writing, even this podcast, if you don't answer what's in it for them, you may as well hang it up.
Right.
So I think what I hear you saying is it's not about, hey, can you give me a referral because it helps me to grow? It's about, I'd like to provide the same great service that I've offered you to your friends. Is that what you're saying?
100%. And here's the key insight, Mindy, is that successful people don't like to ask for anything. But successful people like to give. And so if the advisor can think about it as giving something to the client, as opposed to asking for something, it's transformational in their thinking.
Is there anything else? What would be, it sounds like that's number 1 through 10, but
Right.
what's number 11? What are some other transformative strategies you've written about in the book or you share with your coaching clients?
As it relates to business development?
Yep.
So I would say that the same theory applies to building a network of professionals, CPAs and attorneys and other centers of influence that would refer their clients to the financial advisor. And there are a couple important insights on that. And most advisors aren't particularly good at this. And it's because they really miss out on the two reasons why CPAs and attorneys refer. And the reasons that CPAs and attorneys refer their clients to the advisor is, number one, they like and trust them. And two, that the advisor was really clear with them on the type of client they have that they can help. And so when we coach advisors on building a COI network, professional referral network, we tell them you have to invest time up front in building a relationship of trust with the CPA And you can't do that overnight. You have to cultivate and work at it. And it's delayed gratification. But if you don't take that step and really focus on building the relationship, then you're not going to have the fertile ground you need for them to provide referrals to you. It's just common sense. And then once you built that relationship of like and trust, then you have to be really clear with the CPAs and attorneys on specifically the kind of clients that they have that you can help. And we coach advisors, but the best way to do that is to share with them examples and case studies of clients that they've actually been able to help, so that the CPA or attorney can be really clear with which of their clients would benefit from referring to that financial advisor.
Okay, that all sounds reasonable and right. Probably much harder to execute in real life, but reasonable and right. Let me shift then to what you wrote about in book number 3, which was about the FA team. And in today's world, whether it be because big firms encourage advisors to form teams because it's better for the firm because the assets are stickier, or because advisors choose to work on a team to increase capacity and scale, what are some of the best practices you wrote about and still think are highly relevant when it comes to structuring the ideal FA team to maximize performance?
Yeah. So, the team best practices that I would share, one is making sure you have the right people doing the right things on the team, and that you're not duplicating things that are not necessarily important. And I would say that looking at the team and saying, do we have the right number of advisors covering our clients? Are they being serviced, and are they being contacted with the right frequency? And really being thoughtful about which advisors are covering which clients. Also making sure that the teams have adequate administrative coverage so that the partners on the team can focus on doing what's the most productive task, which is contacting clients and business development. I would also say that the frequency of communication with the team is important, and a lot of advisors haven't formalized that. So we recommend having daily, what we call stand-up meetings, where the advisor meets with the team briefly every day to make sure that everybody knows what the priorities are and that the high priority tasks are being done and everybody's on the same page to start the day. Having weekly team meetings and then having semi-annual strategic meetings are the 3 layers of meetings that we recommend, and find that a lot of advisors don't necessarily do that formally, which we think they should. Another important part of effective teams is having good leadership. And here's the challenge, is that just because an advisor is successful doesn't mean that they have leadership skills. And yet these advisors that have reached these high levels of production, 10, $20 million, they're running these big teams, but they've never been trained on how to be a leader before. And so developing, learning, educating themselves, being trained by coaches and their firm on being good leaders is another really important aspect of a high functioning team. Having, as I mentioned, roles and responsibilities, but very clear, but also making sure that you have regular performance reviews with the non-FA team members, and that the compensation of the team members is not solely based on, but there is compensation that's provided for administrative team members that perform at a high level so that they're incented to do that. So again, Mindy, there are a lot of different traits, but I would say that those are some of the more important ones of a success.
Yeah, and I appreciate you sharing that. You mentioned the 10 and $20 million team, and that's not uncommon. There are relatively few of them, but becoming less uncommon. And it is, I think, that they do things differently than, say, a $3 million team does. What do you think is, if I had to ask you and put a gun to your head, what is it that a 10 or $20 million team is doing in general differently and better than a smaller producing team might do?
Well, there are a couple things. One is, what I've seen is that the top producing teams, the senior partners are they're hyper focused on acquisition of high net worth and ultra high net worth clients. They ultimately understand that the lever in this business is the affluence of the clients they work with. In other words, it doesn't take any more time to invest $5 million from a client as it does $500,000 for a client. But if you invest $5 million, then you're going to get paid 10 times as much than if you invest 500,000. Increasingly affluent clients, that being a formula for success because of the leverage and the amount of assets that they're able to invest. So it's not only being focused on business development, but it's also about always looking to have the average client size being higher.
Yeah. So actually, that you took the words right out of my mouth, because my next question was going to be, how should an advisor think about moving up market, being able to attract more sophisticated and higher net worth clients? So I think most everyone would agree that it's not just about business development, where the senior partner is focused on business development, but you're saying focused on business development for increasingly high net worth clients. So what are the best practices for that?
Well, first of all, you have to develop a practice that's appealing to an ultra high net worth client, right? The needs of somebody that has $1 million to invest and the needs of somebody that has $10 million to invest is entirely different. And so you've got to build your practice around the needs of the ultra high net worth client, which in my view is providing a family office experience for them. Ultra high net worth individuals want to have one professional advisor that is capable in their team of handling every aspect of their financial life, to include tax strategies, intergenerational planning, philanthropic strategies, risk management strategies. Portfolio management, while important, is really table stakes. If you want to go up market, you have to develop a practice that's appealing to people that are up market. Number one is looking at the clients that you have that are at the higher net worth and having referral conversations about having them introduce you to people that are like them. And so being selective in the referral process of really focusing on the higher end of your practice and building a COI network, a professional referral network, that clientele, that the ultra high net worth clients as their clientele, so that when they provide a referral, it's the right kind of referral. So those are some thoughts.
And those are great thoughts. You say ultra high net worth clients want a family office experience where they have one professional advisor, one stop shopping to handle every aspect of their financial lives. Do you have a perspective, Dave, on where the most successful advisors who service ultra high net worth clients and are able to offer a family office experience sit? Are they best able to do that at the Morgan Stanley, Merrill Lynch's, UBS's of the world, or best able to do it as an independent?
I think that the answer is yes to all the above.
Yeah.
We have worked with a number of private wealth advisors at the wirehouses, and they have differentiated their division of advisors, segmentation of their advisors, where there are dedicated advisors, they call them private wealth advisors, that focus on the 10 million plus space, and they're trained and they're given the resources to do that in the wirehouses. At the same token, there are many RIAs that are formed by private wealth advisors that have decided that they want to go out on their own and they want to go independent. So they have the training, they have the knowledge, they know how to build a practice that's appealing to private wealth advisors. They have many private wealth advisors, but they decide that they want to start their own RIA firm or join an independent firm. And so they take their skill set and their clients with them. And so there are many RIAs and independents that serve the ultra high net worth very effectively.
Yeah, I share your perspective 100%. I think when I started this podcast 7 or 8 years ago, it was called Mindy Diamond on Independence. And it was all about the migration of advisors leaving the wirehouse world to go independent. We renamed the podcast a while back to be called the Diamond Podcast for Financial Advisors, to be more inclusive, because we agree 100% that the most successful advisors can practice anywhere they want to. It comes down to how an advisor wants to live their best business life. For some, that means being an employee of a big firm or a small firm. For others, it's about being independent. That's what drives it. And the great news is that as the industry, as the ecosystem born to support advisors has expanded, An advisor can find their version of utopia and what they need to service their designated client base, no matter where they practice. We agree with that.
I agree with what you just said. I think some advisors, they're very comfortable with the wirehouses. They like the support. They like the fact they don't have to worry about all the things that a business owner has to worry about. And the wirehouses serve that very well. There are other advisors that are more entrepreneurial in nature and really like the idea of running their own business and being responsible for their own bottom line and profitability. So I think it really depends on the personality and what, as you described, what their utopia is. But I think the skills are transferable if you're a successful IA and vice versa.
Yeah, I agree. The industry is shifting rapidly. Fee compression, consolidation, tech disruption, private equity entering the space in a big way. What can advisors be doing today to future-proof their businesses and build them with the end in mind?
All the things you say are true. I look at the transformation of our business in my professional lifespan, and it's absolutely incredible. When I started, we were called account executives and we were salespeople. That's what an account executive is. And now, the term is financial advisor or some variation of that. And I believe our industry has been elevated so high that from a professional standpoint, a financial advisor is really not a salesperson. They're really a professional advisor. And so while there have been numerous changes in our industry, all for the positive, the fundamentals really haven't changed on people that are successful. And that's building trusting relationships, focusing on understanding what the needs of the clients are, and building plans that are customized to those needs, frequent communication, and a high level of service. And I would tell you that 40 years from now, I expect the industry to be radically different, but those fundamentals will not have changed. And so I think that what advisors today have to be willing to do is move and change with the times and not be complacent and understand technology, understand artificial intelligence and how it can add productivity, understand the technology that's available today to enhance the client experience, and continue to work on their professional designations so that they offer the highest level of expertise to their clients. So while I think the fundamentals haven't changed, the industry certainly has. And the advisors that move with the change and stay with it or ahead of it are going to be the ones that continue to be the most successful.
Yeah, I would agree with that. And I'm speaking as a recruiter, and I don't necessarily mean to be, but the truth is I share that perspective because I think sometimes moving with the times and not being complacent can include choosing to leave your firm if you don't believe that your firm or the status quo serves you best or allows you to optimally reach or build with the end in mind.
So, Mindy, let me add to that. I think that the best advisors never take their clients for granted. I think that the best advisors are always showing their value in every way they can to their top clients because it's highly competitive. I think the onus is on the firms to do the same thing. Yeah. I think the firms have to treat their advisors and they have to continue to earn their willingness to stay at the firm. And in doing that, they have to continually ask themselves, how can we add more value? How can we continue to be valuable to our advisors so that they're willing to stay where we are? And if they don't do that, then you can't blame the advisor for looking at more attractive alternatives.
Yeah.
And I would just add to your point.
I agree with that. And I think you hit the nail on the head that advisors move less because they don't think their firm has the capabilities they need and more because they feel an incongruence, which we talk about a lot on this podcast, between their goals and the firm's sensibilities. As the firm begins to mandate things or ask things of the advisor that they don't necessarily think are in their or the client's best interest, that incongruence is often what drives movement more than anything else. But I want to pivot, Dave. So let me ask you a question, your thoughts about succession planning and legacy. We started the episode talking about the newbie advisor and then the emerging advisor. But now let's flip to the senior advisors. Big firms have almost all offered retire in place programs, which is a mechanism by which advisors can monetize their life's work in place without having to make a change. People can go independent and build their own and then ultimately sell the business on the open market. So lots of different options. But if you were writing the book today and talking about succession planning and legacy, what advice would you give?
Yeah. So I'm surprised at how in the last 5 years, the focus has been in terms of our coaching advisors on succession planning. And I think a lot of it has to do with the demographics of our country and in our industry. And that is, there's so many advisors that are reaching retirement age, the baby boomer population, which there are 80 million people that are in that. And as they are aging, they have to begin to think about succession planning. And so we coach advisors a lot on succession planning. And to give you a couple thoughts on that, one is I don't think you can start early enough in developing a succession plan. I think one of the pitfalls is advisors wake up and say, I'm burnt out, I'm tired, and I'm ready to retire. And they haven't taken the steps necessary to ensure a successful succession plan, which is in their best interest to do, not only for their clients, but for them financially. And so I don't think you can start early enough in thinking about and developing a thoughtful succession plan. The second thing I would say, and this is really hard for successful senior advisors, and that is if they want to have a successful succession plan, they have to become less relevant. And that's really hard for people that have built their whole practice on being relevant. And so it's hard for senior advisors oftentimes to let go the way they need to if they're going to have a successful succession plan. The other point that I'd make, and this is an obvious point, but important, is to be very thoughtful about who it is that is going to be part of your succession plan. Are they the right people? Are they the kind of people that can help the business not only maintain itself, but continue to thrive and grow? And do they have the interpersonal skills so that they can relate to the best clients of the practice so that those clients are retained? And then finally, we've developed what we call this transition spreadsheet. And what we've done is we've categorized kind of 4 categories of transition in succession planning. One is where the junior partner is passive with the top clients of the practice. The second stage is where the junior partner or the partner or partners that will be the advisors that are the succession advisors have a dual role in the relationship with the senior advisor. The third stage is where the advisor that will take over the practice has a primary role with the senior advisor being part of it. And then finally, the succeeding advisor actually taking over the relationship. And so in my view, you've got to go through those 4 stages. And I think that the senior advisor with the junior advisor need to plot that out with their top 50 clients and evaluate constantly which stage are they in, and are they moving towards the junior advisor reaching that stage where they basically are running the relationship. So that's a tactical step that we coach advisors on taking.
Yeah, and it sounds right to me. I love what you said about a senior advisor needs to make him or herself less relevant. And I think that's probably easier said than done.
Yes.
But how long do you think it typically takes? And I recognize it's different in every situation, but how long does it typically take a team looking for a succession plan to go through those 4 stages?
3 years.
Really?
Yep.
Okay.
You asked me ideally, that's not always the case, but if an advisor came to me and said, I need to really get serious about my succession planning, and I've identified who it is that I want to be part of that, how long would be the ideal time that the succeeding partner or the partner that takes over would retain virtually every client? I would say ideally it's 3 years.
I like that. Okay, that's a good prediction. Let me ask you something else. How about technology? I feel like in every interview I've done with a thought leader, I ask the question about what role they see digital tools and AI playing in the future of the industry. I'm curious to know. I doubt those are things you talked much about your books that were written years ago, but it's certainly an important topic today. So I'm wondering what you think about it with respect to the future of the industry.
Well, I do have thoughts on it, and I'll take you back 40 years when I started in the business, and we had what they called a quotron that had 8 total pages on it. 8 total pages. You couldn't do any more than, and basically it was inventory of bonds and new issue stock and research. That was it. And I shared a quotron with somebody else. It was on a swivel board. And that was our technology then. And I look at what has happened in that 40 years in terms of where technology in our industry has come. And it's incredible. It's like science fiction. If you had told me what's available now 40 years ago. So I think that it's incumbent on advisors that are committed to being successful to stay in front of technology and be willing to get out of their comfort zone in learning it and using it to enhance their practice. And I think that so much of it has to do with increasing productivity. I'm just learning now about artificial intelligence, and I'm blown away by how much more productive it can make me. And so it has huge productivity implications for financial advisors, as does all the technology that's available today. But I would say that the fundamentals of success in this business, or the things that are the most important, don't involve technology. Technology helps productivity, but it doesn't build trust with clients. And at the end of the day, the reason a client engages a financial advisor, and by the way, pays them a fair amount of money, is because they fundamentally trust that advisor, that they know that advisor knows what they're doing, that the advisor puts their interest in front of their own, the advisor cares about them at a deep level, and the advisor is professionally competent. And technology will never replace that.
Yeah, I think that is absolutely spot on. And it goes hand in hand with what you said earlier. The best advisors are never complacent. They move with the times. So they learn to embrace technology, AI included, to make them more efficient and better. But the best advisors are never going to be replaced by technology.
We're in agreement.
Dave, it has been an absolute pleasure. I am so grateful for your making the time for me today, for your sharing with such generosity and transparency your wisdom of 40 years in the industry. We love your books. I can't tell you how many advisors I talk to that think your books were what put them on the map and gave them their start, and they're grateful. So I say thank you on behalf of the industry, not just myself. But is there any parting advice, any last words of wisdom you'd want to share before we wrap up?
I do. And thank you for all of that. I appreciate the acknowledgement of the influence that I've had in the books and the influence that they've had. So thank you for that. And it was my pleasure to be part of your podcast today. So my parting thoughts are the following. One is that this has been my only related career is financial services, but I can't imagine that there's a better one. It really does have so much opportunity and so much upside potential and so much ability to make a positive difference in people's lives. I just can't imagine there'd be a better career. And today, there's never been a better opportunity in terms of growing a practice than there is today. And so what I would just ask your audience to ask themselves, what are you doing every day to get in front of your future clients? Because if you're not doing that, someone else is. And if you've got a great practice, then you owe it to yourself and to your future clients to make sure that you're telling their story and you're getting in front of them on a regular basis. So that would be one thought I would have. The second thought is how you spend your time will define your success. In my observation, the single difference between top producing advisors and advisors that never reach the highest levels is how they spend their time. And the most productive activities you can engage in is your contact with your best clients and spending time growing your practice, bringing in new affluent clients. And then thirdly, I would say, and this is my final thought, parting thought, is take a minute as an advisor and reflect on all the good things that you're capable of doing for your current clients and your future clients, and go out with a mission that you can make a positive difference and that your career can be most fulfilling by getting in front of and making a positive difference with people that need your help. Be almost a missionary in that calling. So those are some parting thoughts.
I appreciate that. Thank you again, Dave. I'm excited for us to share this episode with the world because I think that it's powerful, and we'll look forward to talking again.
Thank you, Mindy.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibility seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.